Tosh Kojima is with us on set. He's managing director and head of the Japan Asia Focus Group at DC Advisory. And a reminder, Sarah Hewen is still with us from Standard Chartered Bank. Tosh, good morning to you. So let me ask you about this consumption tax levy. Last time Japan pushed through a sales tax like this, it seemed to kill off the prospect of a green shoot recovery. Why go for the same policy again?
Well, I think it's the underlying logic behind the consumption tax hike to 10% by October 2015 is basically they need more money. They need more money because they are selling the story that they need to raise a consumption tax in order to put money into a welfare system. But the skeptics around that have a point that of the 170 billion that the government is claiming to raise through the consumption tax, first to 8% by April 2014 and then to 10% by October 2015, only $12 billion out of the 170 billion annual additional income the government is expecting is going to the welfare. So the rest of it is really coming from the earlier story, the structural inefficiency in a coalition government and then consecutive change of government, which is really creating a lot of inefficiency in the system.
It's a frustrating story for investors because, people are itching to buy corporate Japan because, as Carrie was pointing out, some tremendous success stories in the exporting side of the economy still, and yet policy paralysis and peculiar policy decisions still seem to deter investors from wholeheartedly jumping back into the Japanese markets. We don't seem to be able to break convincingly through this 9,000 mark on the Nikkei.
Sure. It is true that, as Lagarde was saying, that the weak euro and eurozone crisis is making yen very, very popular. And some might say that the Japanese prime minister is actually blaming the euro for its own problem at home. It is hard when the yen dollar is trading where it is for them to be able to make money from the export. But some of the cleverer companies have moved onto the offensive through doing active M&A. A lot of people have missed this, but the last year, 2011, Japan became the third most acquisitive nation after only United States and UK in acquiring foreign assets. If you cast your mind back 4 years ago, sterling to yen was 240. Now it's 120. It's twice a bang for its buck. As long as you don't repatriate the money back into Japan, they can keep on fueling this acquisition spree. And some of the very, very good names, very good assets out of Europe, in the absence of U.S. buyers, have gone to Japanese in the recent auctions.
Tosh, we're seeing reports this morning that the Japanese government could run out of money by October. So is Japan going to find itself in a similar position as the U.S. With difficulty to raise the debt ceiling and to finance the state, essentially? And what does it tell you about the attractiveness of JGBs?
It is actually worrying because, as you know, the less and less Japanese domestic retail public is actually buying JGBs. I think Japanese annual budget is something in the order of $1 trillion US dollars. The deficit is running at $500 billion US dollars. Basically, it is in a permanent structural loss. Doing things like consumption tax hike, if you are going to entirely rely on it, you will need to raise a tax to 2017 and barely break even. The fundamental issue with the Japanese economy is that it's a low nominal growth rate target. It's 1% compared to US and Europe's 3 to 5.3% target. And so long as the Japanese government are complacent and happy about letting the economy slog along at a very, very low growth rate, it is just not going to solve the fundamental issue.
Assuming the corporate Japan carries on with the acquisition spree that you were just talking about there, what does that mean for the future kind of landscape for corporate Japan? What do Japanese corporates look like further out if this trend continues? It's quite stark.
Well, interestingly, the biggest change that the Japanese company will have to go through will be a cultural one, because many international Japanese companies now have a larger portion of our revenue, as well as a larger portion of white-collar workers working outside Japan in a very, very different environment. What we come across when my firm is a M&A advisor, which happens to belong to Japan's second largest investment bank, Daiwa Group. My firm, DC Advisory, transacts something like 80 transactions a year. Quite a large portion of it is now Asians or Japanese buying into Europe. One of the issues that we come across is a post-merger integration is something that Japanese are only beginning to really embrace, because in the last round of a Japanese asset spree, those were asset acquisitions. Now they're buying companies for strategic reasons, which means that they have to get the management linkage work. And so it's fundamentally transforming the way that the Japanese companies think, recruit, grow people. And that's the biggest change that we're seeing at the moment.
What are the kind of companies that your clients are looking out for now? Where do the Japanese companies see the opportunity in Europe?
Well, first of all, there are several sectors, but of course technology. And when you say technology, you would think about Silicon Valley, first of all. However, interestingly enough, if you look at the technology sector, over half of all Japanese outbound acquisition over the last 5 years had been done inbound into Europe. In the industrial sector, on high-end manufacturing, where the process know-how, skill, etc., is required. Even looking at areas like China and Southeast Asia, Brazil, all these growth areas, the technology footprint and platform that are used in those markets have been originated in Europe. So the Japanese are looking for European footprint, European technology and know-how and skill, engineering skill, to acquire. And of course, in the consumer and retail sector, the European brands are very, very desirable for Japanese buyers still.
Sarah?
Yeah, Tosh, I think it's a very encouraging story that there is money coming into Europe. But I'm also interested in the Asia region. Where are Japanese companies making acquisitions more closer to home?
It depends on, that's driven by the maturity of the market. And as you know, China still has too many issues around the governance issue, as well as ownership restriction, as well as a lot of opaque, indirect, invisible barriers of entry in terms of M&A. If you look at direct foreign investment, of course, China ranks as number one for the Japanese outbound investment per se, but not through M&A. In M&A in China, and same things are experienced by US and European companies. It's mostly through joint ventures, commercial alliance, technology transfers, all these things, and Japan is no exception. In terms of acquiring companies as a going concern, they are looking at Southeast Asia, which is just behind China in terms of hitting that $10,000 motorization threshold. Now China and the rest of Southeast Asia is connected by Great Mekong Highway, which cut down the speed of transport from 3 days down to several hours. And that is really opening up the economy, and Japanese are in there probably earlier than the Europeans have realized that.
Good to have you in, Tosh. Thanks very much for helping us out. Tosh Kojima, Managing Director and Head of the Japan Asia Focus Group at DC Advisory.